167 and we owe 159 at the federal level alone. And I came to the unflattering conclusion after 40 years of study that I couldn't understand derivatives. Something's got to give. The math don't math. Scares me the most of anything are the high yield ETFs,
Mhm.
ma and pa investors that are scrambling for yield in credits that they don't understand. The US dollar lost 75% of its purchasing power. We did this before. Not coincidentally, the gold price went up, what, 26, 27 fold?
Oh God, I have to tell you, this was such a fun interview. Welcome back to Zhang Enterprises. I mean, I had the honor and so much fun interviewing Rick Rule today. He has spent more than 5 decades in the precious metals and natural resources markets. He's navigated inflation, deflation. He was there in the 70s like I was as we shifted from at least a quasi gold backed system into a pure debt based system. But you know what I like the best, honest to goodness, and this is going to seem so weird, is we had such a deep conversation about derivatives. Now, you guys know me, and you know that I bring that up regularly, but this was really the first time that I had an opportunity to talk to somebody this brilliant on that topic. So I want you to watch this more than once, and you'll hear me say that in the interview. But seriously, I think I loved this interview, and I think you will too. So the first question that I really want, you've been around for a very long time, very well respected, and I really appreciate you being here. But I have to ask you, you've lived through a lot of financial cycles. Does this one seem similar to ones you've had in the past, or how might this be different?
If you give me the word use of the word similar, then
Well,
yes. Uh,
okay.
it
Similar,
it
chaos.
reminds me the most of the 1970s
Yes.
in the sense that we're coming off 20 or 30 years of fairly benign economic climate. I'm not suggesting, by the way, that World War II was benign, but the post-World War II period from 1945 uh, to 1970 was really fairly benign. US dollar hegemony, declining interest rates, strong economic growth. And underlying that was an investment focus on industries that were non-extractive. The growth of the United States is an example.
Mhm.
So the Nifty 50 is an example in the 60s attracted a lot of investment attention. There was not a lot of investment attention paid to underlying materials. Well, the use of those underlying materials was growing. There was a coiled spring aspect to it. At the same time, the economic climate in the late 40s and the 50s, in fact, most of the 60s, was so benign that people forgot to be afraid. They forgot to understand what was happening to the federal budget, what was happening to tax rates, uh, what was happening to underlying wage and cost explosion. And that all came to a head in 1970. I think that's very similar to the
Mhm.
circumstance that we face today, Lynette. If you look back at the period 1982 to 2022, uh, I suspect that when history is written, that will be the most benign investing epoch in human history.
It's kind of interesting that you say that, and then also, like, you said that they weren't really paying attention to the underlying materials. Are you talking about, like, commodities, like
Yes,
lumber and
yes, absolutely. Absolutely. Our society had been underinvesting in productive capacity around raw materials literally since the Depression. We used a ton in World War II,
Mhm,
came
mhm.
out of World War II unconstrained. We were more worried about a depression or a recession than we were about economic growth. And the consequence of that is that we underinvested in productive capacity, even as we were using up our developed resources. Very
Interesting.
similar to
It
today.
well, you know, you also, I agree with you 100%. And there were things that are happening then and things that are happening now. But the other thing was a lot of distraction in the 70s and the 60s and the 70s. So was it the distraction that you think maybe caught? I mean, I can't even say because I was there. I was born in 54.
Yep.
So I remember that period, you know, really well, and the Vietnam War and all of the I mean, there was chaos, the women's lib movement, civil rights movement, oil embargo.
I'm less active, less, pardon me, less capable of commenting on the sort of zeitgeist, the sociology.
Ah,
Uh, I don't know how to dress myself. I don't own a TV, so in terms of all that, I'll rely on you to fill in the blanks of my testimony.
mm-hmm,
Uh, I can just say that we underinvested in productive capacity at the same time that demand increased, and we ignored the increase in underlying supplies. The the place where this market maybe resembles a different bull market in commodities has to do with the market that we experienced 2000 to 2010. And there, I think the wild card really was the urbanization of China, the realization of Deng Xiaoping's statement to become rich is glorious. I say we because it's a triumph for humankind. We incorporated 500 million impoverished rural Chinese into middle class existence.
mm-hmm.
And we generated a tremendous demand for resources, competition from a people who hadn't competed with us before because they were too poor. Uh, we have done, uh, I think, as a species, a tremendous job in the last 40 years of raising the poorest of the poor from being desperately poor to being nearly poor. Uh, and it's my belief that we finish the job in the next 20 or 25 years. There are a billion people on Earth who have no access to primary electricity. And I think they're going to get it in the next 20 years. That's going to generate tremendous demand for energy of all sources, but tremendous demand too for things like copper and all of the things that go into enabling people to enjoy the life that you and I live. So I think the 10 years that are in front of us incorporates the circumstance that confronted us in the 70s, persistently high inflation,
Mm-hmm.
but also increasing demand for commodities in the face of declining supplies of commodities. And that gets exacerbated by the introduction of a billion uh, extraordinarily poor consumers coming into the market and becoming increasingly wealthier. Um, a pretty interesting circumstance, one fraught with risk, of course. Inflation is a bad
Mm-hmm.
circumstance in anybody's mind. And the people in the West who aren't prepared to deal with a billion new competitors for the stuff of life will not like the diminution in their living standards that comes from having to compete with a billion people. But making a billion people less poor is a good thing.
Rule's historical framing establishes the entire thesis. The comparison to the 1970s is precise, not casual. The post-World War II period from 1945 to 1970 was characterized by exactly the same dynamic preceding today's crisis. A multi-decade bull market in non-extractive industries pulling investment capital away from commodities even as underlying material demand grew. The coiled spring of underinvestment built for 25 years before releasing explosively in 1970 to 1980. Then from 1982 to 2022, the spring was wound again, 40 years of the most benign investing environment in human history, during which commodities were repeatedly and severely underinvested. The additional variable this cycle, 500 million Chinese already lifted to middle class with 1 billion more about to follow, means commodity demand in this cycle is structurally larger than the 1970s, not smaller, while supply is more constrained. The collision of 1970s-style monetary debasement with this scale of demand against declining supply is what Rule characterizes as a pretty interesting circumstance, which in his measured vocabulary means historically unprecedented.
Well, I do agree with that. Um, although like the 70s, we are transitioning into a different, well, I don't brand new, but a different monetary system. Do you think
You are
that's going
correct.
to go super easy, or,
No,
what
I
do
think
you
it's
see there? Because that's the
I
same thing.
I think it's gonna be a mess, Lynette. I mean, a mess. I don't know how we deal with it because, again, I don't own a TV. I can just give you the arithmetic of the problem. In this country, which I still maintain is the most dynamic culture on the planet, but in this country, hold on, let me a second, let me kill this. In this country, the numbers around our money are staggeringly bad.
Yes.
The on-balance sheet liabilities of the US government are at 38, almost $39 trillion. When people hear a trillion, their eyes glaze over,
Hmm. Hmm.
but it's a real number. Much more challenging to me is, and I'd be interested in your listeners' response, the off-balance sheet liabilities.
Yes.
According
Yes.
to the Congressional Budget Office, the net present value of unfunded entitlement promises, net present value, not the nominal value, exceeds $120 trillion. Now you add those two numbers together, 39 trillion and 120 trillion, you get a fairly ugly number, 159 trillion. That number is relevant when you put it in the context of the Internal Revenue Service estimate of the private net worth of all Americans combined,
Hmm.
which is $167 trillion. We're worth 167 and we owe 159 at the federal level alone. It gets worse, of course. The off-balance sheet liabilities of the US government are estimated by the Congressional Budget Office to be increasing at between 2 and $3 trillion a year,
Hmm.
and the on-balance sheet liabilities are increasing by about $2 trillion
Hmm.
a year. I mean, something's gotta give. The math don't math.
No.
Now, what we could do is we could do what the Argentines used to do. We could have an honest default. We could say to the bondholders, "Too bad, so sad. No money, strong letter to follow." And we could say to old folks like you and me, "Yeah, we know you paid into Social Security for 60 years, but there's no dough left, so you aren't getting any." That would be the honest thing to do, but that's not the American way.
True.
What I think we do is we honor the nominal value of our obligations and we inflate away the net present value of our obligations,
Yep.
which is what we did in the 70s. We didn't index taxation to an accurate measure of inflation. Yeah, you got it. You got it. In the decade of the 70s, Lynette, and you've probably already discussed this with your listeners, in the decade of the 70s, according to the Office of Management and Budget, not some cranky old libertarian, the US dollar lost 75% of its purchasing power. We did this before.
Yes.
Not coincidentally, the gold price went up, what, 26, 27 fold?
Hmm.
This isn't to suggest that the gold price goes up 26 fold from here, by the way. But I would suggest to you that it will take a 75% devaluation in the purchasing power of the dollar to make our nominal obligation serviceable. You'll get through it fine. You add value. I'll get through it fine. I add value. A pensioner on a fixed income
Yeah.
who is spending $4,000 a month today needs to know that he or she will need to make $16,000 a month 10 years from now to sustain the same standard of living that $4,000 sustains today. And that's a truly ugly number.
This is the most important segment in the interview because it converts the abstract debt crisis into unavoidable personal arithmetic. Rule does not moralize. He simply performs the calculation. $159 trillion in federal liabilities against $167 trillion in total American private net worth means the U.S. government has already pledged effectively every dollar of private wealth in the country to cover promises it has made. The $8 trillion gap is not a cushion. It is a margin of insolvency that is shrinking by $4 to $5 trillion per year as both on-balance and off-balance sheet liabilities compound. The Argentine comparison is rule at his bluntest. An honest default is the mathematically clean solution, but politically impossible. So the government will do what it always does, honor the nominal number while destroying the real purchasing power, exactly as it did in the 1970s. The 75% dollar devaluation in that decade is not an opinion. It is the Office of Management and Budget's own figure. Gold went up 26 to 27-fold during that devaluation. The pensioner example is the most personal and most brutal number in the interview. If you're spending $4,000 per month today and do nothing, you will need $16,000 per month in 10 years to sustain exactly the same lifestyle. That is not a number a fixed income reaches on its own.
Yeah. Well, there's something else that, and I hadn't really ever thought of it this way. So this is a reasonably new thought process that I was going through because, of course, being American, you don't really want to think that our government would do an overt confiscation, certainly of our wealth. And they certainly have in this country many times. But the last time was 1971 when Nixon defaulted on Bretton Woods. So all of those governments whose gold that we were holding with the promise to convert the dollars into them and they could take it back, nobody ever says that's a confiscation, but every country has a gold revaluation account. The U.S. is not alone in the unpayable level of debt or promises. And there's no way to even know unless you might have a way, but I haven't figured out how to know how many derivatives are against all of this stuff and what's really happening in that market after 15 years of ZERP. But I'm convinced, and you say however you think anyway, you're going to anyway, which you should. But I think that we're transitioning into a brand new system and that these transitions like the 70s are not easy for most people. What are your thoughts? Will we end up in a confiscation more overt? Because price manipulation is a confiscation, taxation, inflation, all of that is a form of confiscation.
The most honest answer is I don't know. The more nuanced answer is that if politicians steal from you and I overtly, there are costs to them.
Really?
Yeah, I think
I'm
there are.
sorry, Rick. I haven't seen too many of those costs. But
Well, there are prospective costs.
Yeah.
If they came and said, "We are only going to let your IRA invest in government securities," I think they would become acquainted with the fact that there were 400 million guns in private circulation in the US. If they came to steal your gold again, I think there would be real political costs. If, however, they persist with deficit spending, if they persist with inflation, if they persist with artificially low interest rates, which subsidize spenders at the expense of savers, there are more spenders than savers in society, and they get rewarded for that same material. Uh, they get rewarded for those policies of wholesale theft, and they get punished for retail theft. If you assume that people seek rewards and they minimize risk, then Congress people, understanding that they're extremely popular and they get reelected, if they inflate, if they spend, if they steal from one small set of constituents called savers to benefit a very large constituent called spenders, they do well. And it seems to me that the course of least resistance until it doesn't work anymore.
Rule's wholesale theft versus retail theft framework is the most politically clarifying insight in this interview. It explains precisely why overt gold confiscation and IRA nationalization are both politically unlikely, while the slow destruction of purchasing power through inflation is essentially guaranteed to continue. Politicians are rational actors responding to incentive structures. There are significantly more voters who are net debtors and spenders than voters who are net savers. A policy that transfers real wealth from savers to debtors through inflation is a political winner. The mechanism is opaque enough that most voters do not feel stolen from until it is too late. Overt retail theft, seizing gold, forcing IRAs into treasuries, is visible, targeted, and produces immediate political backlash, including, as Rule notes, 400 million privately held guns. Wholesale theft via inflation is invisible, diffuse, and produces political gratitude in the form of nominal income gains. The course of least resistance until it doesn't work anymore is the most important phrase in this segment, because at some point, the inflation mechanism fails and the system breaks. The rest of the interview prepares viewers for that moment.
Is the status quo. Now, you mentioned earlier in the discussion a wild card, which is derivatives.
Mm-hmm.
You may know I've been in the banking business on and off for 45 years of my life, and I built a reasonably large brokerage firm. And I tried really hard to understand the risks presented to myself, my organization, my customers from derivatives. And I came to the unflattering conclusion after 40 years of study that I couldn't understand derivatives. I
Yep.
My avocation, proof that I'm a boring boy, is that I try to analyze the balance sheets of very complex financial institutions, JP Morgan Chase, Goldman Sachs. While other people watch the Super Bowl, that's what I do. And I can't understand those balance sheets. And I'm good at balance sheets.
Mm-hmm.
I had a discussion with the then treasurer of Goldman Sachs some years ago. And I said, explain to me how the equity slice that you have in Goldman Sachs uh, can intermediate a $60 trillion derivative liability. And he said, well, you're talking about the notional liability. That liability is hedged one against the other, in effect, 30 long, 30 short. We're the guarantor on both sides. I said, yeah, what about if somebody doesn't pay? You know, I mean,
That's called counterparty risk.
yeah, I mean, what level of capital is required to balance or intermediate, guarantee what level of derivative liability? The upshot of that is when I was looking for a clearing firm for my broker dealer, I looked at 13 clearing firms, no, 16 clearing firms, doesn't matter, some large number of clearing firms. And in the end, uh, rather than focusing merely on the level of services or the price for those services, I settled on balance sheet stability. I went for a clearing firm that had the lowest of liability relative to their capital base. And I would suspect, Lynette, that not one of 1,000 of your listeners reviews their banking or brokerage relationships the same way.
Mm-hmm.
That leads me to think that the possibility of a 2008 style
Mm-hmm.
liquidity event, which is very different than necessarily the outcome of inflation, but a very fast moving liquidity event, is a risk that's really understated because I don't think it's in people's minds. When I look at the way people act, when I look at the way people open brokerage accounts or insure themselves or bank without any reflection on the underlying derivative liability, it tells me that the possibility of a scare associated with that is very, very high. I'm not an economist, so I can't quantify it, but I do study the way people invest. And the way people invest does not pay as much attention as it should to the stability of the organizations that investors trust their money with.
The Goldman Sachs treasurer anecdote is the most quietly devastating moment in the entire interview. Rule: a man who has spent 45 years in finance and spends his weekends analyzing the balance sheets of the largest financial institutions in the world, asked the actual treasurer of Goldman Sachs how their equity slice intermediates a $60 trillion notional derivative liability. The treasurer gave the standard answer: positions are hedged 30 long against 30 short. The firm is the guarantor on both sides. And Rule asked the follow-up that the standard balance sheet analysis never reaches. What happens when somebody doesn't pay? The word the treasurer used was counterparty risk. The Goldman Sachs equity base was approximately $80 to $100 billion at the time. The notional derivative liability was $60 trillion, a 600 to 1 ratio. The hedging assumption requires perfect correlation between long and short positions and zero counterparty default. In a crisis, precisely when counterparties default, those correlations collapse and the netting assumptions fail simultaneously. Rule cannot quantify this risk. He says so directly. But the fact that an investor with his level of expertise and access cannot quantify it is itself the most important data point. You cannot manage a risk you cannot measure. And not 1 in 1,000 investors checks whether their broker or bank has the balance sheet stability to survive a fast-moving event of this type.
Well, frankly, you brought up a really important point, one that I've struggled with but understood for a really long time when it comes to derivatives. And anybody that's watching, if you're around in 2008, I mean, it was happening before then, but the public became aware of it in the subprime when they dried up in 24 hours. So even if you were slated to close on your house that next morning, it was not happening. Go back and look. And that was the second big derivative explosion after long-term capital management. But the point that you brought up is you're brilliant. You've studied this for 45 years. You've had to balance everything and you don't understand them. And my concern is that the people that create them and manage them, they don't understand them either. Because I've read some of their documentation where they actually said, and it was before I understood print screen and I haven't been able to find it, but they said, if we make this really complicated, nobody will question us. And that's true with money in general, right? People, well, I don't understand it, so they must understand it. And I think that's why they don't question it. But do you think that a derivative implosion, because we can't even see it, it's the guys that make this mess, that own everything, Seed and Company, all the JP Morgans and Goldman Sachs, that create this mess, can determine whether or not there is a default on it, but we can't even see it. Can we?
I think 2008, we saw the product of it.
Mm-hmm.
And I will say, I was in my own way guilty, not of creating this product, but not seeing it. I remember very well to this day, driving north on the 405 freeway in Los Angeles toward LAX. And on the east side of the freeway, the right side as you drive north, I saw a great big billboard. It said, borrow 125% of the value of your home, bad credit, okay. I was not a real estate lender, but I remember thinking, because I am a lender, I wonder how this works out for them. Well, ironically, that billboard was paid for by Ditech, which was the mortgage subsidiary of General Motors, which went broke. But the idea that I, who's lived in financial services my whole life,
Mm-hmm.
take that in late 2006 as an indicator and reorganize my own portfolio more substantially is, I think, a reflection of just how guilty our society is at taking responsibility for their own
Yeah.
future.
Yeah.
If you look at the consolidated balance sheets of the equity component of the balance sheets of the big financial services firms in the US, relative to their aggregate notional derivative liability, um, I'm not saying it's going to blow up. What I am saying is that nobody knows if it's going to blow up. It's an unquantifiable risk that people aren't paying attention to. I am now. Uh,
Yes. Me
I
too.
have personally, since the year 2000, maintained liquidity in US dollars, but I've saved in gold. It,
Me
it, it
too.
turns out, it turns out accidentally that was a good idea. Uh, That isn't why I did it. I did it because if there was a blow up, I'd prefer not to play, you know?
Exactly.
This 23-second disclosure is more significant than its length suggests. Rule is not recommending gold as a speculative trade. He describes the structural role it plays in his personal balance sheet, operating liquidity in dollars, long-term savings in gold. This inverts what most investors do. They keep savings in the currency and speculate with commodities. Rule keeps the currency for short-term operational needs and uses gold for capital preservation over time. And critically, that isn't why I did it. He did not buy gold in 2000 because he predicted the bull market. He bought it because if the derivative and debt system he could not fully understand blew up, he did not want to be holding paper claims against institutions that might not survive. The outcome was favorable, but the motivation was insurance, not speculation. This distinction matters. His gold holding is not dependent on a bull market thesis continuing to be correct. It is there regardless of whether gold goes up or down.
That is, and I like how you talk about people taking personal responsibilities because that is all about the mantra. I think as we transition from the system that we're in now, which is barely limping along. I don't know if you agree with it or not, but in 2008, Shearson was my alma mater. That's where I was a
Right,
stockbroker. So I
right,
was really paying very close attention to that. And it was those two Bear Stearns. Actually, there were three things that happened for me, right? Number
right,
one, it was July of 2007, where when the US dollar index fell to the lowest level ever against its trade weighted basket. And I just went, oh, something nasty this way comes.
yeah,
I mean, I remember that very well. And then it was the Bear Stearns, those two funds. You always have to be careful how things are named because they're just the opposite. That went what to nothing overnight. And that was that like March or April of 2007, February, something like that. So you could feel there was something in the air. I remember kind of being like freaked out. To be honest with you, I'm like, there is something very nasty that's coming this way. But
and
I
then
was
Countrywide.
shocked when they let Lehman go out. I was
Yep,
shocked when they did that.
right,
And
and then, of
then
course,
Lehman, they
blow
said, I'm sorry, go ahead.
sorry, the blow up of Countrywide, I think, is, what brought it down to a household level off Wall
Yeah.
Street.
But it's like people don't see it until it's right in their face.
Right.
Do you think this time could be different than that? Because that's what I'm hoping.
Uh, I mean, the honest answer is, Lynette, I don't know, and I don't wanna find out. I I sort of think that the complacency in our society at every level is dangerous.
Yes.
There are a lot of things now that are better than 2008. The bank balance sheets, although they're stretched by derivatives,
Are they?
if you X the derivatives, the bank balance sheets are much better than they were. Primary capital at JP Morgan Chase is in double digits, uh, despite the FDIC saying that a 7%, um, a 7% equity slice is sufficient capitalization. American banking has discovered that a higher number is probably better. I'll tell you what really scares me, and I don't wanna make this whole interview doom and gloom because I think there's lots of bright things out there.
I do too,
The
but let's talk about the doom and gloom for a minute.
the thing that scares me the most of anything are the, high yield ETFs.
Mm-hmm.
Ma and pa investors that are scrambling for yield in credits that they don't understand. These high yield ETFs have literally trillions of dollars in them, and they're extremely liquid. I mean, extremely
The
liquid.
moment.
The problem is that what they own is extremely illiquid. And if we came to a point in time where the ma and pa owners of these things began to express concern about credit and sell them, The managers of these funds, in order to fund these extremely liquid redemptions, have to sell extremely illiquid junk bonds. That's a run on the bank. Well, we had a saying when I was a young broker. I did a lot of high yield stuff in the old days, back when high yield was cheap. And we called an illiquid bond an owl bond. What that meant, Lynette, was when you called your broker to say sell, he or she would say, to who? To who?
I love that. I'm going to use that, Rick.
Please do. And the thing that really scares me among, aside from derivatives, I mean, the thing that scares me as being the pin that could pop the balloon
Mhm. Mhm.
is this proliferation of what should be private credit in public ETFs among people who own it simply for the yield without any understanding whatsoever of the credit risks that they're
Yes,
running.
yes. So, when you're talking high yield, because people hear that, would you define for our viewers what high yield is, and also the level
Well,
of leverage that has you concerned in these ETFs?
I think for the average investor, any debt that isn't investment grade, I mean, isn't triple B or better, probably any debt that isn't investment grade, and also no, I wouldn't include publicly traded because I'm okay with prime rate bank loans. You know, to I'm okay with bank loans to, as an example, Exxon. That doesn't bother me.
Mhm.
But the triple C's
Yeah.
to Schlepp, Schmuck, and Schmo Automotive or Red Lobster. uh, uh, People own these ETFs that are agglomerations of sub-investment grade credits, and those credits were established by Wall Street to benefit the issuer and generate a fee. They were not constructed for the benefit of the buyer. Uh, the buyers are, in very ugly parlance, yield whores. They chased 50 or 60 basis points or 100 basis points and gave up completely any focus on credit quality.
Rule's high yield ETF warning is the most specific and actionable risk identification in the interview. He is not describing a vague systemic risk. He is naming the precise structural fault, the liquidity mismatch between the ETF wrapper and its underlying holdings. High yield bond ETFs trade on exchange like stocks. They can be bought or sold in milliseconds. The bonds they hold cannot be sold in milliseconds. In a credit crisis, when millions of retail investors simultaneously decide to exit their positions to get to safety, the fund managers must sell the underlying bonds to raise cash. But the market for triple C rated bonds issued to Red Lobster does not have a deep bid in a crisis. The price at which those bonds can be sold falls catastrophically precisely when everyone needs to sell simultaneously. The owl bond metaphor, when you call to sell and your broker asks to who, is one of the most vivid risk explanations in financial education. There is no buyer. This is a run on the bank in ETF form, hiding in plain sight in trillions of dollars of retail portfolios held by people who think they own something as liquid as a stock, but are actually holding illiquid credit packaged by Wall Street to generate fees for the issuer, not to protect the buyer.
Yep.
The second concern is, I think, duration. If you believe, like most of your listeners do, that inflation is expressed by the CPI, I think you need to reorganize your thinking. The CPI would have you believe that the underlying rate of deterioration, the purchasing power of the US dollar, is 2.7%. Any of your listeners who use their common sense and compare a basket of goods and services that they acquired in 2020 against the price levels of that same basket of goods and services today will understand that that 2.6% is fallacious.
Mhm.
Besides which, the index, when it's inconvenient, doesn't include food or fuel. If you could see my total self, you would see that lunch is important to me. So that index is less relevant. And the index also doesn't include tax. Now, I would suggest, Lynette, and I think that your viewers, if they examined it, would agree that the real underlying rate of deterioration of the US dollar is more like 8%.
Mhm.
That's where the problem is. If you are saving in a US 10-year treasury at 4.15 and you're getting paid back in a currency where the purchasing power is declining by 8, there's a negative yield.
Mm.
Where that hits investors is that any long bond they own, any duration longer than 5 years, is exposing them to a negative real yield. And it exposes them to a capital loss if, as in the 1970s, capital markets come to understand that long bonds are destroyers of capital. So the people who are investing in these yield products with a sacrificing credit quality for yield and also assuming duration risk, which I think is underpriced, uh,
Yes.
really, really, really dangerous. They're really dangerous. And so often in public forums, when I'll discuss this, I'll be faced with a concerned couple that says, "But Mr. Rule, we need the yield," as though their own needs mattered somehow
Right.
in terms of the efficacy of what they were doing.
Right.
It's very unfortunate. I'm not gloating.
The duration risk argument is the second half of the bond destruction thesis, completing the credit quality argument in the previous clip. Rule has now identified both ways the typical yield-chasing investor gets destroyed. Credit default when illiquid high-yield bonds find no buyers in a crisis, and duration loss when the market reprices long bonds to reflect real inflation rather than the CPI fiction. In the 1970s, the 10-year Treasury lost approximately 40 to 50% of its real value over the decade, as inflation ran at 8 to 10%, while nominal yields lagged. The investor who bought a 30-year Treasury in 1965 at 5% received 5% per year for 30 years, while the dollar lost 90% of its purchasing power. The closing anecdote, the concerned couple saying, "We need the yield," as though their own needs mattered somehow, is Rule's driest and most devastating observation. Their need for yield is real, but the bond market does not care about their need. The laws of mathematics do not adjust for personal financial necessity. If the vehicle providing the yield is simultaneously destroying real purchasing power, the investor's need for income is not being met. It is being quietly consumed.